Hi. In our second mini lecture on Chapter 13, we're going to be talking about ratio computations. In our first mini lecture, we looked at horizontal and vertical analysis, and those two, together with ratio computations, help us to have an idea of how well a company is doing. It helps us to measure and evaluate the company's performance. Ratio computations help financial statement users to understand relationships among various items reported in the financial statements. And today we're going to be focusing on the profitability ratios, which relate to the company's performance in the current period. In other words, the company's ability to generate income. So let's take a look at these. And by the way, you've already done most of these ratios, if not all of them. Back in Chapter 3, we learned about the net profit margin ratio. We take net income and we divide by total revenues. Now, if you're dealing with a company that sells products, that would be net sales revenue. If the company is a service-based company, it would be total revenues. And this ratio represents the percentage of revenue that ultimately makes it into net income after deducting expenses. The gross profit percentage we learned back in Chapter 6. And this is used for companies that sell products because we take the gross profit, which is net sales minus cost of goods sold, and we divide by net sales. And this indicates how much profit was made on average on each dollar of sales after deducting cost of goods sold. Now, when you did vertical analysis, you already calculated both of these. So it's a bit of a repeat of a portion of vertical analysis. Our fixed asset turnover we learned about in Chapter 9. And there we take our net revenue, and remember the word net means something has been subtracted. If it's net income, we subtract expenses from revenue. If it's net sales, we've subtracted sales returns and allowances and sales discounts. In net revenue, there's something that's been subtracted. If it was a company that sells products, again, it would be sales returns and allowances and sales discounts. For the fixed asset turnover, we take that net revenue minus whatever was important to be deducted. Perhaps it was a discount or a return, or perhaps some type of other reduction of the revenue, perhaps for a dissatisfied customer, and we divide by average net fixed assets. Now, your fixed assets are your long-lived tangible assets. That's just another way of saying it. And they want us to net them. Well, what would fixed assets be net of? What would be subtracted from fixed assets? It would be the accumulated depreciation. And then they want us to average that. So what we would do is we would take our net fixed assets or net long-lived tangible assets from the end of last year, add the net fixed assets from the end of this year together with that, and then divide by 2 to get the average. If you live within the company, so to speak, you would have access to 12 months worth of data, and you could take the end of month data for the net fixed assets, add them together and divide by 12. But often investors and creditors and people looking at financial statements only have access to year-end data. So we would take last year's net fixed assets at the end of last year and the net fixed assets at the end of this year, add them together and divide by 2 to get the average. And the fixed asset turnover indicates how much revenue the company generates for each dollar invested in fixed assets. So how good was the company at taking the long-lived tangible assets and generating revenue from that? And this is often a measure of how good a job management has done. The next one is return on equity, and this was from Chapter 11. The chapter on corporations. The return on equity compares the amount of net income earned for common stockholders to the average amount of common stockholders' equity. So how good was management at taking the investment of the stockholders and generating income? For this one, we take our net income and we subtract out preferred dividends if there is preferred stock. So we want the net income that's available only to common stockholders. And then we divide by the average common stockholders' equity. Again, we usually take the end of last year's common stockholders' equity, add the end of this year's common stockholders' equity, and then divide by 2 to get our average. Number 5 is earnings per share. Again, a ratio we learned in Chapter 11. And the numerator is the same as return on equity, net income minus preferred dividends. If there are any preferred stock shares, then we would subtract the dividends related to those out of the net income. So we would end up with net income that's only available to common stockholders. And then instead of dividing by the equity dollars, we divide by the average number of common shares outstanding. That means in the hands of the stockholders, right? It would be the issued shares minus the treasury shares. And we would average that out between last year and this year. And the earnings per share indicates the amount of earnings generated for each share of common stock outstanding. And our last item here is the price-earnings ratio. This relates the company's stock price to its earnings per share, and it reveals what investors are willing to pay for a share of common stock. So we take the stock price per share and divide by the earnings per share. How much are stockholders or potential stockholders willing to pay for those earnings? Okay, so now let's look at a problem. We're going to be doing problem 13-4. It's a continuation of problem 13-3. This was Computer Tycoon, if you recall. I'm going to make this just a little bit more clear here. And these are 4 of the profitability ratios that we just learned. The first one asks us to compute gross profit percentage for each year and assume the change from 2015 to 2016 is the beginning of this sustained trend. Is Computer Tycoon likely to earn more or less gross profit from each dollar of sales next year in 2017? So first we have to calculate 16 and 15. So I'm going to kind of divide my paper in half here like this. Not a straight line, but that's okay. And I'll put 2016 in one column, 2015 in another. And I'm going to write down my formula here. It's the gross profit, which is sales minus the cost of goods sold, divided by net sales. And then I'm going to multiply it by 100 to change it to a percent, and then round to 1 decimal place. And by the way, in Connect, they will tell you the number of decimal places to round things. Be very careful about that. Read carefully. And if they show a percent sign, they want the answer in a percent, so you've got to multiply by 100. But not all items, not all ratios that you're asked to calculate are asked to be expressed as a percent. For example, fixed asset turnover is reported as a decimal. So let's look at 2016 as well as 2015 gross profit. Our gross profit for 2016 is $40,000. Our gross profit for 2015 is $48,005. So I just turned back to the first page. And we're going to divide by our net sales. In 2016, it's $100,000. In 2015, it's $120,000. And we're going to be multiplying by 100, remember? To change that into a percent. And then we round to 1 decimal place. So we have 40% even in 2016 and 40.4% in 2015. to answer our question assuming that the change from 15 to 16 is the beginning of a sustained trend, is Computer Tycoon likely to earn more or less gross profit from each dollar of sales next year in 2017? Well, if this is a trend, they actually earned less, from 40.4%, or 40.4 cents of each sales dollar became gross profit. In 2016, only 40%, or 40 cents. So this is a downward trend. They're more likely to earn less gross profit. Our answer would be less. Okay, now for net profit margin, our formula there is our net income divided by net sales. And again, they want that in percent format, so we'll multiply by 100. Net income for 2016 was $2,500. For 2015, it was $6,025, and we're going to divide by our sales revenue. And our ratios are 2.5% for 2016 and 5% even for 2015. Please do this on your calculator to make sure you end up with the same amounts. I find that when I use my cheap calculator, I have to hit the equal sign after each step. For example, if I divide 2,500 by 100,000, I then hit the equal sign and then multiply it by 100 to get my percent. And when you're rounding, remember, if the number to the right of the place you're rounding is 5 or above, you increase the place that you're rounding to. If it's less than 5, you keep that number as is. Now our question here is, given your calculations in requirement 1 and 2, explain whether Tycoon did a better or worse job of controlling operating expenses in 2016 compared to 2015. Well, let's take a look. We're going to flip back to the first page. And while we see that the gross profit was fairly close, but the net profit is half. Why is that? Well, it's primarily because of those operating expenses. As a percent of every sales dollar, the operating expenses, in other words, the selling, general, administrative expenses, increased as a percent of every sales dollar. You'll notice the gross profit was fairly close. It would decrease by only 0.4%, but our net income decreased by 2.5%, and that's because as a percent of every sales dollar, our selling, general, administrative expenses were not as tightly controlled as they should be. Interest expense did not increase that significantly, and income tax went down, so we did not control our expenses as well in 2016 as we did in 2015, so we did a worse job. Our third ratio is the fixed asset turnover ratio, and here we will take our net sales and we will divide by our average net fixed assets. And again, fixed assets are the same thing as your long-lived tangible assets, and what they are net of is depreciation. We take our long-lived tangible assets and subtract accumulated depreciation, and then we average them. And let's see what information they give us here. It says Computer Tycoon reported average net fixed assets of $54,200 in 2016 and $45,100 in 2015. So they've given us the averages and made our job a little easier. we need to find our net sales for 2016 and 2015. Okay. So our net sales for 2016 are 100. Our net sales for 2015 are 120,000. And it said to divide by average net fixed assets. So for 2016, that's 54,200. And for 2015, that's 45,100. And this will give you a chance to see the rounding process. So if I do my calculation here, and this is not expressed as a percent, so I will not multiply by 100. You can look at Connect to verify that. Make sure you follow the directions. For 2016, my fixed asset turnover is 1.845. Okay. So if they want me to round to 2 decimal places in this case, and Connect will tell you to do that, that means I would round to that decimal place. I look to the right, and if that number to the right is 5 or above, I increase the decimal place here to 5. So my answer would be 1.85. In 2015, my decimal answer is 2.66075. If I round to the second decimal place, again I look to the right, and if that number is less than 5, I leave the second position decimal place as it is. So my answer there would be 2.66. Okay. So my question for number 3 is, did the company better utilize its investment in fixed assets or long-lived tangible assets to generate revenue in 2016 or 2015? Well, they did a better job here in 2015 because they were able to generate more sales, actually, with less net fixed assets. In 2016, they generated less sales with more assets, so they were more effective in 2015. So we will circle that one to help us remember what the correct answer was. They were more effective at using their investment in fixed assets to generate sales in 2015 than in 2016. And our last profitability ratio is the return on equity. We will take our net income and divide by average common stockholders' equity. Now, if there were preferred stock, they would have to let us know that. Computer Tycoon does not have any, so we will not have to subtract out preferred dividends. And the stockholders' equity will just be common stock. So let's take our net income. Our net income for 2016 is $2,500. For 2015 is $6,025. And we're to divide by the average common stockholders' equity. And they tell us that up here. Computer Tycoon reported average stockholders' equity of $54,000 in 2016. And $40,000 in 2015. And this will need to be calculated as a percent, so we'll be multiplying by 100. How do you know that? Look at the way the problem is presented in Connect. If you see a percent in the computer problem, then you have to multiply it by 100 to change it to a percent, and then watch to see what number of decimal places it should be rounded to. In our case, it's 1 place. So as we divide and then multiply this out, we get 4.6% for 2016 and 14.8% in 2015. So using the common stockholders' investment Computer Tycoon was able to generate more net income on less of an investment in 2015 than they did in 2016. So they ask us here, did the company generate greater returns for stockholders in 2016 than 15? And our answer there would be no. We have greater returns in 2015. They were able to more effectively take the stockholders' investment and generate net income in 2015 as compared to 2016. And that ends our demonstration of profitability ratios. Our next problem and our next mini lecture will be on liquidity ratios. We'll see you in a little bit.